Rackspace Technology is currently facing a complex and demanding financial reality, and the latest reported figures make that abundantly clear. The company's profitability profile remains under intense pressure, with earnings before interest and taxes margins sitting at negative 5.6%. That weakness extends even further down the income statement, where pre-tax profit margins deteriorate to negative 21%. These figures indicate that core operations are failing to generate sufficient earnings to cover costs, a situation that places ongoing strain on the business model. Compounding these challenges is a balance sheet weighed down by substantial long-term debt totaling approximately $2,740 million. This heavy debt load has pushed shareholder equity into negative territory, a troubling signal that liabilities significantly exceed assets. When viewed together, these metrics paint a picture of a company grappling with structural financial stress rather than a temporary earnings setback. Adding further context, the most recent income statement shows a net loss of $67.1 million. This loss highlights the ongoing difficulty Rackspace Technology is having in reaching sustainable profitability despite efforts to stabilize operations. While the company did generate positive operating cash flow of $70.7 million, which suggests that cash is still moving through the business, this alone does not offset the broader concerns. High leverage combined with limited profitability creates a fragile financial foundation. For investors, this combination raises legitimate questions about long-term solvency, flexibility, and the company's ability to navigate future economic headwinds without further balance sheet deterioration. Transitioning from financial fundamentals to market behavior, the stock's recent trading activity tells a dramatically different story. Technical analysis shows that Rackspace Technology has experienced sharp volatility accompanied by a strong upward trend. On a weekly time frame, shares surged from a low of approximately 41.9 cents to a peak near $1.72.82. Moves of this magnitude rarely occur in isolation and often suggest a shift in market sentiment. Such price action can indicate a bullish reversal, particularly when it coincides with high-profile news developments and renewed investor attention. The speed and scale of the rally point to aggressive buying interest entering the stock over a short period of time. From a tactical trading perspective, recent sessions reveal sustained momentum as buyers continue to step in. A notable support level has now formed around $1.17, which appears to be an area where demand is consistently absorbing selling pressure. In environments like this, volatility becomes both a risk and an opportunity. Momentum-focused traders may consider strategies that involve entering near established support, placing protective stop levels slightly below that zone to manage downside risk, and targeting potential resistance near $1.70. These levels are especially relevant for short-term participants looking to capitalize on rapid price swings rather than long-term fundamentals. Much of the renewed interest surrounding Rackspace Technology can be traced back to recent strategic announcements, most notably its partnership with Palantir. This collaboration centers on integrating advanced data analytics and artificial intelligence platforms into Rackspace's service offerings. The strategic goal is to appeal more effectively to regulated industries that require robust data governance, security, and compliance. By leveraging these capabilities, Rackspace aims to expand its operational reach while differentiating itself in a crowded market. Partnerships of this nature can act as powerful catalysts, especially when they signal a shift toward higher value services and deeper enterprise relationships. Reinforcing this strategic direction is the appointment of Joseph Vito as Senior Vice President. This leadership move underscores a deliberate emphasis on strengthening alliances and delivering greater value to customers through collaboration and innovation. Following these developments, the market reacted swiftly, with the stock experiencing a dramatic surge that reflected heightened investor optimism. Compared with broader industry benchmarks, Rackspace Technology has demonstrated an ability to respond quickly to transformative strategies. Still, competition within the technology and software and information technology services sectors remains intense, meaning that execution will be just as important as vision. From a technical standpoint, resistance around $1.70 and support near $1.17 remain critical reference points as the stock continues to digest recent gains. Zooming out further, Rackspace Technology's current phase can best be described as dynamic and uncertain, shaped heavily by its collaboration with Palantir and the market's reaction to that news. In February 2026, the daily closing chart captured a striking rally, with shares climbing from roughly 44 cents to a peak near $1.68. This surge reflects a surge in speculative interest and a belief among some investors that the company may be entering a new chapter. Rapid price appreciation of this this nature often signals shifting narratives rather than immediate financial improvement. Despite this short-term enthusiasm, longer-term financial data introduces a more nuanced and cautious perspective. Revenue has remained consistent at approximately $2,740 million, indicating stability in top-line performance. However, operational challenges continue to weigh on results. The company reported a negative operating income of $33.9 million. This suggests that while revenue is steady, cost structures and efficiency issues remain unresolved. Profitability ratios reinforce this theme, with profit margins at negative 9.27%, even as gross margin stood at 19.3%. This gap highlights the difficulty the company faces in converting revenue into meaningful earnings after accounting for operating expenses. Although operating cash flow remains positive and points to a degree of liquidity, it is overshadowed by substantial debt obligations. This imbalance is further reflected in the net income loss of $67.1 million, which continues to erode financial flexibility. Debt servicing requirements limit the company's ability to reinvest aggressively, respond to unexpected challenges, or pursue additional growth initiatives without increasing risk. From a valuation standpoint, Rackspace Technology presents an intriguing but risky profile. The stock's price-to-sales ratio of just 0.11 may suggest that the market is pricing in a high degree of pessimism. For investors with a contrarian mindset, this could appear to represent an undervaluation opportunity, particularly if partnership-driven momentum translates into improved long-term performance. However, caution is essential. Long-term debt continues to overshadow total equity, emphasizing the fine line the company must walk between leveraging new opportunities and managing financial risk. Ultimately, Rackspace Technology stands at a pivotal moment, balancing promising strategic developments against the hard realities of leverage, profitability challenges, and execution risk. For more stock news updates, remember to press the like button and subscribe. With that being said, I will see you in the next video.